Thanks, everyone. Thanks for sticking around. I promise I'll make it worth your while. Oh, that's not my slide deck, though. By the way, that was a terrific presentation. Definitely very, very interested to learn more about that. As the son of a farmer in Australia, I found that very intriguing and certainly something that I'd be personally interested in putting some money in. Yeah, so as you heard, we've been doing this for a little while. We started doing predictive analytics in 2016 when it was deeply unsexy and no one believed it could be done. And so our particular special sauce is that we ended up with a lot of data. And I just see Carter's main representative walking in right now. They've also got a lot of data. I really love reading Peter Walker's insights on our industry. We've used that data initially to invest ourselves, and then we actually started licensing it to other folks. And we now have a couple of very, very large global companies that are rolling out through their ecosystem and using it to screen deals. We have 700,000 deals in our database, but beyond that, we've actually created 20 billion synthetic VC portfolios. What does that mean? We have built every imaginable type of VC fund you can imagine and compared the portfolio results. And what that gives us is deep insights into what works when you're constructing a portfolio. And up front, I'm going to tell you what works is a portfolio that you build with as many companies as possible that you can invest in at a selection ratio of 1%. These are the two critical things that you have to get right. Stage matters also, and you'll see on this graph here, what you can see on the left is our analysis of about 200 venture funds on the left here. And you can see all of that sort of orange-colored stuff. That's 50% of the venture funds that are out there. They don't make money. You're better off, far better off investing in Dubai real estate. When you get into the green color, this is where you're starting to make money. But even there, the first initial ones, you're getting 2x returns, which again is deeply unsexy if your money is locked up for 10 years. So what everyone's looking for is the top quartile return that you only get from the top quartile VCs that are going to give you that 3 to 4x return. So how do you get it? The graph provides a clue, and the middle graph is a different extrapolation of that. In fact, let's move to the middle graph. That middle graph looks very complex, but it's actually very simple. What it says is if you invest in 1,400 companies in your portfolio and you invest super early stage, you'll make 5 to 6x returns. Right? How simple is that? Pretty simple. If you invest in 10 companies and you invest super late stage, you'll make maybe 15%. That's private equity, right? So that's the difference. If you want to go after the multiples, you need to go very early and you need to go very wide. That is the core results of our millions of dollars worth of research that I'm sharing with you now. You don't have to spend the millions of dollars. You just have to adopt that strategy. You'll be absolutely fine. And one of the reasons for that, on the right-hand side here, you can see the other results of our research. What you're seeing there is investment at friends and family round, pre-seed, seed, Series A, and then the rest. Now, what's super interesting about that, this is your return on exit as a multiple of invested capital, MOIC, which is the most popular metric that we use in venture capital. So the multiple on invested capital is significantly better. Even after all of the dilution and everything else that happens along the way, you're still better off to invest super early stage. People don't do this because it's super risky. Super risky. It's not done yet. I need traction. I need to see recurring revenue. Well, yeah, now you're in Series A or even possibly Series B territory. So if you really believe in something, try and get into it as early as you can or get a discount and get in there faster. Okay, so what does our AI do? It's actually 75 models that we've created over the last 10 years. My partner, Dan Hookturp, deserves all the credit for this. Dan had a couple of $1 billion exit with a company called Bankrate that he built with Tom Evans and a few other guys. It's a really successful fintech company that was at one point the 10th most trafficked website in the world. Dan's built our AI models and he's built them superbly. And what these models are able to do is predict future valuation. I'm going to get into that in a second, and also give you some feedback as to what the portfolio should look like. If anyone's interested, and I see some people taking video and pictures of the slides, you can just DM me later. john@hatcher.com works, and I'm happy to send you this presentation. So we did this study, and we figured out that we wanted to invest in 500 companies at a 1% selection ratio. Can anyone tell me how many deals you're looking at? 50,000, right? So how do you look at 50,000 deals using AI models and then handle all that information? So we had to build really ridiculously clever robotic process automation systems to handle all this stuff. That's what you're seeing in front of you here. So our back-end operating system, which we call the FAST system, Funds as a Service system, is fairly unique. It combines about 160 applications and enables us to understand what's going on, automate due diligence, automate all the fund admin inputs and everything else we need to manage the process. Our track record's pretty good. We've done over 400 investments. The first fund's done brilliantly. Second fund, the second cohort, the post-COVID cohort, because we had a pause, is sitting now as it's in the top 3% of VC funds globally in terms of performance, which we're very thrilled about. All right, so let's get on to the meat and potatoes. What we're doing here is we're actually building the first quantitative VC fund with this technology. And here's how we're doing it. Every time someone applies for funding, we generate a Hatcher score. And apologies if this sounds a bit like an advertisement. It's called a Hatcher score, so I can't sort of get around that. The Hatcher score is a score out of 1,000. And so in this instance here, there's a 765 score. For those of you familiar with the US FICO system, 650 means you get a mortgage, 750 means you get a mortgage at a better rate. Our system is quite similar. Below 650, it's very hard for us to invest in that opportunity. Above 650, going from 650 to 750, 750 to 850, what we're able to do then is think about quantitatively weighting our allocation to a company. It's never been done before. That's why we're calling it a Quant VC fund. And so we tested this. We didn't test it with 40 companies or 400 companies. We tested it with 40,000 companies over 2 years. And what we're able to do is accurately put these companies into 3 buckets. We'll go up in value, we'll maintain value, we'll go down in value. Now, 2 years ago, we weren't sure if this would work, so we didn't pay a whole lot of attention to it, to be honest. It was just an experiment that we did. And then we went back after 2 years, and not only did it worked amazingly well. The top tier ended up being about 1.5x, the mid-tier about 0.9x, the bottom tier 0.28x. Now, that's a first. No one's ever predicted valuations for a cohort before going 2 years into the future, and we managed to do that. The methodology, lots of small type. I'm not going to go into it here, but it was very robust methodology. We didn't want to mess around, and we wanted to use a lot of data. This is what some of the actual outputs look like. We predicted funding, follow-on funding, and exits, and we predicted that with a very, very high rate of success. So what this means is we're able to determine whether a group of companies would exit and whether they would get follow-on funding or not. There's a term in data science called lift, where you look to see how well your model's outperforming just a random assessment of how, or a baseline of how that model should perform. Our lift, in this case, we were able to predict funding, follow-on funding and exits with up to a 10x level of lift, which was pretty unheard of. We also saw this in our H2 fund, so we got to use this with our own live data, and we saw almost exactly the same results, which is pretty amazing. So why is this important? All of you guys in this room, I assume, are either founders or you're allocating money to venture capital investments. And the way that's typically been done is the team comes and presents, and you think this is a pretty looking team. This is a great presentation like the one that we just saw. Yeah, I like the story, I like the team, and that's how you invest. Upstairs from that, the funds have much less differentiation. Yes, it's a pretty looking team, but their IQ range is the same as the guys that you saw yesterday. All right, so that team's walking in with a track record and a team that's got a pretty smart bunch of guys that's connected to deal flow and connected to everyone they need to create value, but very hard to differentiate that as a fund that you can invest in. So for the first time, what we can offer allocators is a science-based approach. So you can actually deliver a strategy that has predictability built into it. And this is a first. It's never happened before. There'll be lots of people like Hatcher that come along in the next few years, and they will have models that they've also spent 9 or 10 years building, and they will make similar claims. But this will be the core of venture investing going forward, whether it's Hatcher or whether it's one of our competitors. This is how people will invest. within the next few years, and certainly 5 years from now, this will be the standard. All of us will use some form of machine learning-based data models and algorithms to invest in what is currently a very manual gut feel process, will be replaced with a lot more smarts and a lot more science-based algorithmic approaches. So what we're doing here is quantitatively weighted investment. We license the technology to anyone that wants to use it. We'd happily do a deal with Carter or anyone else that wants to take this out into the world. We just did 2 deals with 2 very, very large companies to license this to them. What we keep secret is our proprietary allocation algorithm. So that's what we keep for our own funding purposes. So I'd love to have any of you guys that are in the room interested to learn more. Let's come together and let's build the first quantitative VC fund. It's possible. That the tech is proven. I'm around for the next hour or so, and then I have to go to DIFC for a meeting, but I'm based here now in Dubai. I'm very happy to say recent Golden Visa recipient and loving living here. So thanks for the warm welcome, and I appreciate you listening to our story. Thank you.